We are joined by John Wake at Real Estate Decoded, has worked professionally in real estate, but mainly focuses on the data side.
What happens if we get into a recession? But when you look at the interest rate, the payments only went up like 40%.
There's a belief out there that we have to see a crash.
Real price will be kind of flat for several years, but real incomes should be increasing.
Do you have any thoughts on the impact of the Airbnb-ing of everything over the last 5 years?
So what you want to look for is what I call a 10-year home.
The first-time buyer is the health of the market. If you don't have a healthy first-time buyer, you cannot have a healthy housing market. Welcome back to the Educated Home Buyer. We have a great conversation on tap for you this week. We are joined by John Wake at Real Estate Decoded. He's out of the Phoenix market, has worked professionally in real estate, but mainly focuses on the data side. He has a background in economics, follows the data very closely, and has some thoughts and ideas that are really good around real estate and may vary from some of the other guests that we've had in the past, and may dovetail with them. So we're going to go through that. We're going to talk about some detail of the Phoenix market. We've talked about Southwest Florida, Texas, areas where supply is increasing. The Phoenix metro is one of those, not nearly as much as Texas and Florida, but they've seen some softening in prices. They've seen increases in supply, and we're going to go through that. So, John, thanks for joining us. Anything I left out there in your background and what got you to analyzing real estate data?
I'm just a numbers geek, and so I got into real estate a strange way. I found out there was public records on what a home sold for. So this is in like the year 2000. Like neighbors would talk about, what did that house sell for? No, I don't know. The real estate agent said this. And you didn't know, but I found out it was available. So what I did was I bought it from a company, and then I put it out as an email newsletter. Email was hot stuff back then. An email newsletter, so you could subscribe to your zip code and find out the official sales price of all the sales each week in your zip code. And so that kind of took off. But that was like it was 5 years before Zillow came out doing the same thing. So I thought I was going to sell ads and make a publication, but that was too new. They weren't doing that. So I said, people keep telling me that they want to see a home and I'm not making any money. You moron. Get a license, become a real estate agent, and start showing homes. And so I did that. And
so you were actually pulling the data together before you were selling homes. So you knew kind of the direction of homes and the values, but then transitioned into selling real estate from there?
Yeah, I just wasn't making any money. And after 3 years of that, it's like, I got to make some money. And so I got a license in 2003 and caught the boom.
Yes, that was absolutely in the Phoenix market everywhere, but that was a giant boom prior to the bust there in Phoenix. So prior to getting into the real estate data space, you were an economist, an agricultural economist with the USDA?
Yeah, I worked in Washington, D.C., and then also worked at the American Embassy in Paris for a couple of years. And then I came and moved over to the Arizona Department of Agriculture for a while, and then made a big change into doing some geeky data stuff.
Well, let's transition from that. You say geeky data stuff. I love numbers. One of the things that when you were talking that reminded me, I've done this for 29 years and we had the internet. Like I remember I graduated college in 95 and in 95, they were kind of talking about the internet and you got an email account my senior year. And all of our listeners who are much younger than me are going to go, Grandpa, what are we talking about here? Like we've always had email. But watching the shift and the change in data that is available, like pre-Zillow, it was difficult. We had access to an economist at First American that I followed from that 97 to about 2002, 2003 timeframe, because he had data that wasn't available anywhere. So to see it sort of get democratized, where everyone has access to a lot of really good data, there's sort of like this thing that we have a lot of data, but then there's also confusion over which data is accurate. What do I look and how do I get it down to my market? But before we kind of jump into how you think people should analyze their local markets, maybe talk a little bit about one of Jeb's favorite sayings here in dealing with the more emotional side of it. I do mortgages, I do numbers. That's more logical. The emotional side is housing. He says, in everything, but especially in real estate, people make their buying decisions emotionally, and then they come back and they justify it logically. And that's kind of where that data piece comes in. What are your thoughts on that?
That is totally true. People they'll go see a home, And they don't even know why a lot of times. I just really like this home. They don't know, subconsciously it reminds them, I don't know what, their grandmother's home or something. They just like it. And they oftentimes can't put their finger on why they like it so much. Could be the neighborhood when we drove in or whatever. So there's a ton of emotion involved.
Well, let's talk a little bit about the Phoenix market. That's where you have the best data on. What are you seeing there in terms of an increase in supply? Maybe that transitioning over to a little weakness in prices. And then from there, let's talk about what we can glean for other markets based off of that.
Yeah, so the Phoenix market was one of the craziest markets. Oh, in fact, it was increasing faster than any other market at the beginning of COVID in the whole country. So it was totally skyrocketing. And what we're seeing now lately is that we started out in January with kind of still a little bit low supply, but now we're back to normal. The amount of supply we had, the number of homes we have for sale right now is the same as in 2017, which is a normal year. And it might still be going up, but nevertheless, we're kind of normal right now. And in fact, the price right now is about the same as it was 12 months ago. In fact, it's about the same as it was 2.5 years ago when the prices were going straight up. But and then they went down, they went up a little bit, and they've been flat for like a year. So that's kind of where the market is. Now, the big question is, in my mind, is like recessions. We're kind of wobbly because we have super low sales, like 1/3 of normal. I mean, it's the lowest sales per month as from like 2008. I mean, it's super low. But it's balanced because the number of homes hitting the market is so low. So its prices aren't moving much up or down. So that's where we are. But what happens if we get into a recession? The economy in Phoenix has been one of the strongest in the country. So that's helped keep things flat. So, but if we get into a recession, I'm worried that does that cause a cascade effect? But who knows? People talking about recession. They were talking. There was a lot of talk about a recession in 2018, and then of course when so anyway, it was
because I think it's an important conversation, and it's important to know that no one has a crystal ball on it. Those who have different indicators, the SOM rule, yield curve inversion, we have all sorts of things that people have looked at and saying, recession is coming. As you said, 2018, 2019, prior to COVID, people were like, we are going on a 10-year expansion. It wasn't the most robust expansion in the economy, but we had not seen any periods of negative growth for over 10 years. We are overdue. And then you have the COVID recession, which to me is not really a recession. It was like 60 days and very justifiable and explainable. And then we're off to the races and had a very, very hot economy. So some things that people don't understand or realize, or our listeners may not understand or realize. Everyone likes a robust economy. When you get a new job offer at 20% more than you were making, that's awesome. But all of those good things about a robust economy are inflationary. Homes start getting much more expensive. So we had a unique period of expansion where we had artificially low interest rates. They would have been low regardless. But if the government had backed away after 60, 90 days, said, okay, this isn't as bad catastrophic as we thought it was going to be. If they back away from bond buying and are out by the end of 2020, we're not going to see what we saw in home prices because we would have still had that relatively hot economy, not as hot. It would have moderated because of not having that stimulus of ultra low interest rates. But absent that, take away, because you can't put the genie back in the bottle. Assets of all types went way up because it was very cheap to acquire and finance them. But the flip side of it is now everyone says, well, I want rates lower. Well, low rates typically come with a slow economy. If not an outright recession, a slow economy. So when do people like buying things? They like buying things when they feel really good about their job. There's other pieces to it. It's the right time in my life. I got married. I had a kid. All of those things sort of lead to it. But do you think people are sort of discounting that there's a balance here? And I guess Jeb and I both have a belief. You're saying Phoenix for the last couple of years has been relatively flat. There's a belief out there that we have to see a crash, major correction. The primary reason for that belief is both mainstream media and people in for lack of a better word, real estate creators on YouTube, on Instagram. If it bleeds, it leads. It's easy to sell and say, this is coming. So
true.
You saw this in 2007, 2008. This is what we're going to see today. But there are other ways for it to revert to a more normal structure than a big crash. What are your thoughts on bigger picture, the likelihood of a crash or an extended period of sideways of what you're kind of seeing in the Phoenix market right now?
there's a lot of people who like to say, well, it's not going to be as bad as last time in 2008. Well, that's a really low bar. Of course, but what I use as my model now, kind of the savings and loan. Oh, this is before your time. The savings and loan, prices fell nationally about 15%. Real prices, adjusted for inflation, fell about 15%, but it was super variable back then. Some places went, like New York and the Northeast and California tanked, and other places had almost no movement at all. But now it seems like the market is more synchronized. All the cities are more synchronized nationally. So how much have we come down now? Maybe 5% in Phoenix. So if we came down another 10%, real prices, this is real, then that would be like savings and loan. And that to me is kind of the best case scenario, where prices are flat nominally, but with inflation over time. So if prices are flat for 5 years, but with inflation, they go down 10% or whatever over that period of time. That would be, to me, the best case scenario to get prices back into line. Because right now, they're still, when you look at the price plus and include interest rates, prices are as high as they were at the peak in 2006. They're super high.
Well, we've never had a period where you had prices spike as rapidly as they did. So 40+% in most markets in less than 36 months. And then when that is over, you normally see a cooling. And we didn't get the cooling. We got a leveling of prices, but interest rates doubled. So the affordability, I always like to tell people, do not get hung up on prices. People don't care about prices. They care about payments.
Yes.
If I can finance it with a 30-year fixed rate at a payment that is a reasonable percentage of my household income, I'm cool. So I am much more alarmed by monthly payments right now than I am by the absolute level of prices.
Oh, totally. That's it. Interesting sidelight here on the monthly payment. If you look at prices generally from 1990 to 2020, so 30 years, they went up, they tripled, went from like 100,000 to 300,000. But when you look at the interest rate, the payments only went up like 40%. So in that case, my ballpark estimate is that prices of the house price inflation, 80% of it was due to falling interest rates. Only 40% was real increases in value. So what's happened now? If prices don't go back down, they're not likely. Prices now are kind of set on 2.7% from at the bottom. So they could go down to that again. But if they don't, we just need to be in a situation where we realize the way you're going to make equity in your home in the future could very well be, for the current generation, paying off your mortgage. That's how you make equity, because it may not appreciate anywhere near. It won't appreciate anywhere near, because they're not going to fall from 10% in 1990 to less than 3% in 2020.
I agree with you 100%. And let's back up even beyond that, because 82 was the peak in interest rates. So we had a 40-year bull market where you go from 18% to 2.5% on a mortgage. You can show people that on a chart. That's easy to understand. But let's go back before that. I was born in 73. There was something really important going on at that time that led prices through the 70s and early 80s to increase. Is we went from single income households to dual income households. Yes. If you look at the numbers prior to the 70s, mom stayed home. And by 1985, 2 out of 3 were in the workforce. So if we go back to what I said, people are far less concerned about the price of a home than they are about how much of their household income goes to the payment. So we had a 10 or 15 year period where home prices were low and we had additional household income as mom went to work. So home prices were popping well above the rate of inflation before that. Now we come back, inflation is moderating and interest rates are coming down. We can continue pumping home prices higher and higher and higher. And the same percentage of household income is being allocated towards that payment. So what do we really have? We got 50 years of outsized home price appreciation. We couldn't replicate those tailwinds going forward if we wanted to. We don't have a third household, and we can't send the kids to work. We can't send Junior at age 8 off to get a job to bring additional household income. If you talk about 18 to 3%, 3 to 1%, if it were to happen, doesn't have nearly the same impact on payments and affordability. So when we look, I think it's critical that people not listen to anyone looking back and saying, hey, for the last 50 years, we've averaged 4.8% home price appreciation in the U.S., when for the exact reasons that you talked about, that's unlikely to be the number. We have seen appreciation in real home prices greater than inflation for a very extended period of time. I believe that can continue in the future, which means affordability continues to inch worse. But we got so far out ahead of it that, to me, we got two competing things that I would love to ask you about here. We have mean reversion, meaning that that number has to correct. And we've talked about it a couple of ways. Crash can do it. Any change in home prices can cause that. Increases in income, which naturally occur over time, and then adjustments to interest rates. And as we talked today, you and I were talking before we came on here, biggest move we've seen in a couple of years in the 10-year. So we're likely to see correction in interest rates, but not back to where we were. But what do you think about sort of those competing things of home prices likely to not see the appreciation going forward, and the interplay of the three things that impact affordability while people still have the desire to be homeowners?
Yeah, my best case scenario is most likely scenario in my mind. Who knows what's going to happen? Is the price will be real price will be kind of flat for several years, but real incomes should be increasing. So in a way, prices are getting less, even though because incomes are increasing more than the home prices. So that would help things adjust over time. But in that scenario is a really long-term scenario. That's like a 5 or 10 year scenario to get things back into a normal. But another thing you mentioned was talking about people tend to put so much money into housing as a certain percentage. It tends to be phenomenal. I saw Cameron Murray out of Australia did a book recently where he talked about it. In Australia, it's like going back 100 years or more. It tends to be about 20% of income, the way they measured it, goes to housing, whether it's rent or whatever. That's overall, not every individual person. Rich people spend a lot less, poor people spend a lot more, but overall it's about 20%. The U.S. may be a little bit more than that, 22, 24. But nevertheless, that's as incomes go up, then people naturally will spend more on housing because overall, on a macro level.
And I don't know if you've seen the chart, but we went during COVID when prices are skyrocketing. A year into it, prices are up 30%, 20%, whatever the number is in your market. I would have people say, this is nuts. I'm not paying that. No one can afford this. I would say, let's look at this. If you go back to 2019, before COVID, that home was more expensive. What are you talking about? The price is up $150,000. I said, well, let's look at the payment for the person that bought in 2019, and let's look at the payment today with someone 1.5% lower in interest rates. And they go, oh, I'd never really thought of it that way. And now part of why this is not a mystery, why we have not record low, but 40-year lows in sales volume, is that number, if we look and chart out the average debt to income ratio for home buyers, and I wish I had the data here because I do have it in a slide deck somewhere, it was really consistent, even with prices going up for the reasons that you talked about, interest rates coming down, qualifying income going up. So debt to income was really consistent. And actually, the early parts of COVID, before the home price appreciation really caught up, it had dipped. It was more affordable to buy homes at higher prices. Now we've seen the exact opposite because of the full brunt of appreciation and higher interest rates. The average debt to income is over 40% now.
That's too high. That's high.
It's too high. It's too high. I mean, can you do it? I have had borrowers. I specialize in first-time buyers. First-time buyers have a higher debt-to-income ratio in general, so you can do it. You don't want that to be the average across everyone buying homes. So with that, maybe talk a little bit about the balance here of things going forward. So a recession would be good in terms of a slowing economy. It would lead to lower interest rates.
Yeah, but I'm worried about if we get into a recession, then the demand side, incomes are coming down so much for that. We're kind of wobbly right now. And if we get a recession, that could really put a lot of downward pressure on prices. So that's what I'm afraid of. Hopefully it would be a small recession. And when we get that, another thing that's different now, I think, than the past recessions is the government is so much more involved in the economy. What they did during COVID, I never, ever would have guessed. How when just money showing up in my bank account and stuff like that, they did.
Whether you need it or not.
I know. So anyway, I think if we did start getting prices falling, the government would be more involved in trying to ameliorate it, to stop it from going. It certainly would never get down like it was. Maybe it could go, I don't know, like 5 or 10% before they would start jumping in and trying to do something to slow down the fall. So that's a change. That's something we didn't have in the past. The government's more involved in the economy.
100%. And it's been a 20-year thing. 2020, definitely post-COVID, but starting around 2020, they definitely, whether it was the Fed, whether it's buying treasuries, they don't allow the natural consequences of things to come to play. And people think We certainly don't want to make the show about politics. There's people that have reasonable disagreements on either side of it. But when the government gets involved and puts their thumb on the scale, it makes unintended consequences. I don't think the government has ever done anything and said, you know what, we can really screw this up. They come in and they say, hey, we have an idea to make something better. And they may very well be right, but they don't think about the 18 things around it that make things worse. So from looking at it from that perspective, I sit and say, yes, interest rates coming down are going to put a floor under how much correction that we're likely to see.
Yes.
But at the same time, interest rates coming down puts a ceiling on how much appreciation you're going to see because it's likely to coincide with a slowing economy.
Yes.
So slower wage growth, less people employed and feeling awesome about their circumstances. So when you ask me, we talk about this, we don't really want to make predictions here, but you do have to forecast for my business, for my clients. We have to go through and your whole thing is forecasting what are the most likely outcomes going forward? What are the things that are playing out? And we see that. I don't see a recipe for rapid appreciation. No. I don't see a rapid for significant downturns in prices because we've gone through the numbers ad nauseum here on the show. The cohort of home buyers is far and away the strongest we've ever seen. Lowest loan to value, highest credit scores, lowest interest rates, lowest debt to income for loans that are in place. Does it mean that they're completely insulated from ever losing their home? No, some of them can and will, but it's not that a few people lose their home. To see 2008, you have a ton of people lose their home. And then we have, again, awesome government intervention to do the exact wrong thing. They bailed out the banks while the banks were saying it's moral hazard if we let people slide on their mortgage.
Oh, my gosh. What happened we saw here is that there was a certain amount of foreclosures that happened that doesn't affect anything. It's just like the market accepted. But after a certain point, the foreclosures got so high, prices just went off a cliff. Like it can handle a certain amount, no problem. But if it gets above this certain amount, it went. So we've changed the mortgage system so we don't have those people walking away like they used to. Or those investors essentially who were walking away. So we shouldn't have that cascade of foreclosures, which would keep prices. If they did fall, it'd be more like, 1990 when it was just a slow fall. But one of the things about the market I was going to say is that a lot of the people, I think the market right now, like if a third of the people own their homes free and clear, so they can buy and sell. It doesn't matter. Interest rates don't matter to them. So that's a third of the market is where it was. Some people who are buying and selling and they paid off a lot. So maybe prices are way high on the house they're buying, but it's way high on the house they're selling. So it's kind of a wash. The only difference is the interest rates. But it's those first-time home buyers that are really in a spot.
And that's the key to the health of the market. It's great for a move-up buyer that goes from a starter home to a bigger home, or the guy that goes from a bigger home to a trophy home. That's all well and good. It's wonderful. But what are your thoughts on this? The first-time buyer is the health of the market. If you don't have a healthy first-time buyer, you cannot have a healthy housing market. Yeah,
that's the thing. They're not healthy right now, but there's a lot of weakness potential right there. And they tend to be weaker financially than people with more income. And so in a recession, they get hurt worse than the average. I feel like in 2008, so many millennials got wiped out. They got set back like 10 years. They did nothing wrong. They just bought a house in the wrong year. Who knew? And it set them back 10 years financially. I can't imagine that would happen again for the first-time home buyers this generation, that the government wouldn't allow it.
Let's close the loop. That's a very important point, but let's close the loop on something that you said. Gentleman that I follow here, he teaches investors in Riverside County, California. So similar market to Phoenix, a lot of entry level, similar price points, a lot of FHA loans. But he has data. He was the first person, we talked about in the 90s, digging in. He said, in 91 or 92, he owned attractive homes in Palm Springs and lost his shorts on it. And he said, I'm not doing that again. I want to know everything there is to know. Went to the Riverside Library, printed out every piece of data he could find, went to Hawaii with 2 suitcases full of data, like printed out, and spent 2 weeks in his hotel room going through everything. Not on the beach, so I don't know why he had to go to Hawaii. He could have gone anywhere. Yeah. So he goes through all the data, and he came to some really solid conclusions that led him in 1997 to tell his investor clients, buy with both fists, to tell them in 2005, we have 6 to 12 months, maybe let it ride, but get thinking of selling anything that's not a core holding, and then telling everyone around 2010, buy again with both fists. And one of the most important pieces of data that he came up with is we in Southern California, I'm sure you've seen the number or the quote where the media would say in 2005, 2006, we've never had a downturn in home prices nationwide.
Yes.
We'll say, okay, who cares? I don't care if I live in a market that has. And for us in Southern California, we had seen 3, if not 4 cycles of downturns in prices. And what Bruce found in going back through the data is look at the MLS. Every time 40% or more of the available inventory in the MLS was bank-owned properties. So to your point where you said, hey, the market can always absorb a few foreclosures, but there's a tipping point. And he found that tipping point was 40%. And the severity of those losses was worse the higher it went. So we ended up with 80% of the inventory for us in Southern California by 2009 was bank-owned properties. Banks aren't in the business of owning homes. They're going to liquidate them at any cost.
Yeah, no, in the early 1990s, LA got totally killed on prices. And we got...
With the S&L crisis. The S&L made a bunch of bad loans, and they lost those properties. And that was, again, they had to liquidate them into the market. And that's why we got crushed.
And part of the mechanism, hopefully we'll never get to this point again, but part of the mechanism here is it used to be, even in the savings and loans, they made the loan, they serviced the loan, they held the loan on their books. But then when you get into 2006, it's just, the servicer doesn't own the house, and he's just paid when you're not making the payments, they're not making any money from you. And then when they foreclose, they don't get paid until the foreclosure is done. Then they get paid for the whole foreclosure work, plus all the months back that they weren't getting paid. So it ended up with a system which incentivized the servicers to foreclose fast. They made more money by foreclosing fast, where back in the savings and loans day, a lot of them foreclosed slow, or they would foreclose and they would rent it out for a year or two. They wouldn't even put it on the market. Because the prices were low. So that was something that, who would have guessed that would have worked out that way, that people would want to foreclose fast. We still have a system like that now, but I just don't think it would allow, maybe I'm being optimistic, that they wouldn't
I don't think
allow
you are. Let me give you
to start
some
the cascade.
Let me give you some insight that you may or may not know. So first of all, we got a preview during COVID, right? What did the government do? Immediately said, all you have to do is ask for forbearance. You don't have to prove hardship, anything. Just ask.
A friend in the neighborhood, I just met him in the park, and he was saying, yeah, I just got online, and in 15 minutes I did it online to get a forbearance.
I have many clients that didn't ask for it and got it. They called to ask a question about their mortgage because they weren't sure at the beginning of COVID what was going to happen with their job. They call and ask a question, and next thing you know, they're in for, like, I didn't ask for forbearance. Like, that's how easy it was.
Wow.
And then all of the resolutions and workouts were fantastic. I'm not saying no one found themselves in a worse situation post-COVID, but many people were able to take 3 to 6 months off, come back, make 3 on-time payments, and then refinance that same loan, bring all the arrearages current at a much lower interest rate and payment after a little 3 to 6 month vacation. And I'm not saying it's wrong and different. No one did anything wrong. That was the way it was proposed and rolled out.
Wow.
But bigger picture today, I have a friend who owns a decent sized mortgage bank, and they service all of their loans. And he has said they have been given very explicit instructions on government-backed mortgages that they are to do everything possible to keep people in those homes. One of the questions that we get a lot, I'm sure you saw, HUD has authorized 40-year modifications. It's not a 40-year loan and why did they do that? Because most people have 2.5%, 3.5% mortgages. You can't modify them down to 1.5% and make much of a difference. But if you stretch it out 10 years, you sure can.
With the same rate?
So, same rate. Just stretch it out to 40 years. And again, in this situation, you do have to show a hardship. It's not as simple as just calling up, hey, things are rough. How can I get that 40-year mortgage? But they are being instructed. We don't want you to foreclose. And I'm not saying that's not a bad form of government intervention, because we could have had far less pain to both the banks and to families and homeowners in 2008, 2009, if we had said, what is best for the neighborhood? What is true loss mitigation? We're going to lose money here. How do we lose as little as possible and keep as many of these families in their homes as possible? And I think that is the future. So we're less likely to have as many families in trouble, and those that are much more likely to be helped. So with that, I would love to transition. I know you have some very interesting thoughts on this. Where I would like to transition to is the impact of investors, or let's say you actually in an email series, if someone subscribes to your stuff, you send a very long email series out. One of the very first things out there is the misunderstanding that people have of why home prices spiked as much as they did during COVID. So we covered a little bit on interest rates, affordability getting very good, people being trapped at home, demand getting pulled forward. There are normal, logical reasons why it did that. But sort of the gasoline on the fire, you have some thoughts around the role investors played in that. Why don't you talk to us about it?
Yeah, just looking at Phoenix, and there's different data sets on investors. But when you buy a home in Arizona, you have to say, is it for primary use, secondary use, or not, or is it a rental? So people can lie, they don't check up. So it's not like, but it's a data set. But looking at 2001, when prices were skyrocketing, the investor purchases doubled, the second home purchases increased, and the live-in owners purchases went down. Prices skyrocketed. Actually, according to that data set, the number of live-in owners who bought, the owner occupants, went down. So it was like, and that's what brought the number of homes for sale was down super low, because investors came in. And that's because investors are so leveraged. When interest rates go down, what's the most leveraged investment you can have? It's going to be real estate. And so when interest rates go down, that favors investing in real estate more than any other investment. So they poured in, and that was the main, with the interest, that was the mechanism. The interest rates went down, ends up with more investors coming in, and that's what caused it. I couldn't believe when I first saw it that the actual in 2021, the live-in owners' purchases were down 2,300 in Metro Phoenix.
And I would bet that Phoenix is probably the peak of that for a couple of reasons. It's desirable to live there. Rents are pretty good. Homes are relatively affordable, especially for people in California.
At least they
want to buy a rental property, and they can go 4 hours away and get a much more affordable rental property with a much better cash flow profile. But sort of the kicker, the last piece of gas on the fire is it's a vacation destination. And we had the rise of short-term rentals. Do you have any thoughts on the impact of the Airbnb-ing of everything over the last 5 years?
Yeah, I think Airbnbs, Arizona passed this law that said local governments can't regulate them. To me, that's totally crazy. They should let local governments, one town likes them, fine. Another town doesn't, fine. But there's a lot of them. And there's some neighborhoods, particularly near downtown Scottsdale, which have really, in fact, one of my sons almost bought in this house. He ended up canceling on the last day of that he could, because there was a dog barking nearby. But anyway, it's good he didn't constantly. So it's good he didn't buy in there, because that neighborhood became famous for having short-term rentals and parties, and it just wasn't good. He ended up buying down in Tempe and in a HOA, which doesn't allow as short-term rentals. So that turned out to be a great neighborhood. So that was just lucky. But I think the short-term rentals take supply. People talk about supply. That's why prices are up. Supply. They're taking supply from live-in owners and putting it into investors. That lowers the supply for live-in owners. Those because they're getting crowded out by the investors. Because they have so many times. Basically, it's because I have a big blog piece on this. They have a zillion tax breaks that investors get that homeowners don't get. So they're able to pay.
That's where I was going to want to transition, John, because of everything, of all your stuff that I've read, the part that I think would be most difficult to implement and also probably the most controversial is your thoughts on changing tax code for investors. So before we jump into that, I'll preface it by saying I told you we had Ed Pinto on. Ed has some very solid solutions for how to increase affordability and housing supply, but it is generally built around easing zoning, permitting, increasing density, and driving prices down. That's all supply side. Your thought is by changing demand from one group, which is investors. So I don't doubt that it would work. I'm not going to put words in your mouth. I would give you the table to talk about what your thoughts are on this and how you think it would work and how it would help.
Yeah, I love Ed Pinto. I've talked to him a couple times on the phone, but he would definitely disagree with my position on this. He's supply like everybody else. But I'm thinking about demand. And I think it comes back to my background in agriculture. It's like every crop is different. And you can't use the same thing for every crop. It's like nitrogen fertilizer works great on corn and wheat, but you don't put it on soybeans. You're just feeding the weeds. So that's kind of, maybe that's a bad way to put it, but it's kind of like feeding the weeds by having tax breaks for the same tax breaks for apartment complexes as you do for single family rentals or condos. It's just allowing them to pay more and drive up prices, and then they end up buying more. When you're a single homeowner, maybe you own one home, maybe you own a vacation home. But if you're an investor, when because of all the tax breaks, they come in when the interest rates are low or whatever, or prices are going up. Instead of buying one, they buy 5. So they can really expand hugely. And I think it's largely, or I don't know, significantly, because of the tax breaks that are inappropriately supplied to single family investors where they shouldn't be. You should okay, single family homes, this is going to be for people who live in the homes. We don't have to apply the same rules to them as we do to every other crop. So that's my, and also if you ever go online to YouTube, just put in everybody who's promoting real estate investment. It's almost all talking about the tax breaks. There's a bazillion videos talking about all the tax breaks for investing. It's not an investment in homes, it's more an investment in tax breaks.
Well, and I know you've thought this through, so you will have some answers and rebuttals to this. As a real estate investor, let me throw this out at you. So I buy a piece of property. It's a depreciating asset. The building is a depreciating asset. The land and the scarcity of that land and the entitlement and the property being on it is going to appreciate over time.
Yeah. But
the structure value, I'm going to have to fix and repair it over time, so I'm allowed to depreciate it. The cost of financing it, I'm going to get taxed on the revenue that it generates, but we realize with any business, there's a cost of generating that. So obviously my mortgage interest is going to get deducted against that. I got to pay homeowners insurance. I got to pay property taxes, all of those things. I just don't know where we would draw the line, because if you take all of those things away, literally no one will. I mean, we talk about the recipe for a housing market crash. That would crash the market because no one would want to own residential real estate. Everyone, other than those with homes free and clear, that they like the rents that they get and they're okay because they've already depreciated the heck out of it. So really, what are we talking about taking away? The taxes and insurance and maintenance and upkeep portion of it. But really, a rental property is treated like any other business. It generates income. The cost to generate that offsets it. So how could you make it work?
Well, if we did it 20 years ago, we wouldn't have had the boom in the 2000s. We wouldn't have this boom here. So the transition's the hard part. How do you do the transition to, for example, just talking about the transition, it's like, okay, we don't want people to bail out. So if you own a home now, we'll give you this new tax break, but zero tax break for anybody who buys from now on. So slowly transition out of it. But to talk about the depreciation, they love this. Like if you have a truck for your business, it depreciates, but it's not tied to the land. A house is tied to the land. I should say, okay, if you want depreciation on the house, you need to also look at the value of the land at the same time because it's tied to the land. This isn't a mobile home. And say, what's the total value? If the total value went down, maybe you can get some depreciation. If the total value didn't go down, it's just a way of applying something that works for cars and investment machinery that doesn't work in homes. They just took this one little thing. Yeah, it goes down, but the land is going up generally a lot. Far more than offsets the depreciation and the value. So I would think that's just silly. I think they should totally get rid of depreciation. It's because they're just looking at the one thing that's going down in value instead of the whole house, the whole property.
100%. That is the difference, in that the underlying land there, especially in places like Southern California, is going to appreciate over time. There's no more land, especially land near the beach, land near jobs, lands near downtown. So it is going to be that.
It's not a huge amount. It's maybe $1,000 a year or something you save, but whatever. It's something.
It definitely impacts it. I'm a little bit late here, but if you're watching the show, you're enjoying the content, we have conversations with experts like John all the time. Make sure you like the video, that you subscribe to the channel, check back here. You can get it on all of your major podcast setups, Spotify, YouTube, any and all of that stuff. So make sure you like and subscribe so that we can get you here every week. John,
one more thing, Josh. If you get rid of the depreciation, that means when you sell the house, you make more money when you sell.
Yeah. Well, you're 100% correct. I have a property. This is funny. Let's talk about this. People love stories. Let's talk about a story. We've talked about it on the show before. I bought right at the beginning of COVID, and it was a property that a past client had destroyed. He had a drug problem and intentionally destroyed the house. So we got it at a very low price right before everything skyrocketed. We had to do a bunch of work to it, but by the time we got done with the work, property had appreciated greatly. We were able to finance it at the ultra low fixed rates that were available thanks to government largesse during COVID. And now in a perfect world, I probably wouldn't own that property. It's not an ideal investment, but if I sell it, I can't go get another 3.25% loan anywhere. In California, we have Prop 13. We talk about unintended consequences. Great idea to keep older folks from getting priced out of homes that they bought at a reasonable price and paid off. So my tax base is based off of what I paid for it, which was half of what it's worth now. I have a 3.25% interest rate. I can't replicate that by moving those funds anywhere. So that's a home that is not in the pool for people to be able to buy. And it's also, I'm trapped. Woe is me. Trust me, we'll get comments in here, people saying, oh, poor you. I'm not saying poor me. I'm saying it's flaws in the system, that all of those things were just unintended consequences of the way the system was set up. Yeah. And I'm not apologizing for owning that property. And it'll be funny. You laugh, John. We'll get people in the comments. You're terrible. You're part of the problem. Listen, the rules are what they are. Our job, and part of why we're here on this podcast, is to teach you the rules and to see where the puck is going so you can make the best decisions for you.
Well, I keep saying landlords aren't the problem. It's the laws and the things like Prop 13 and things like that's the problem.
Yep. No, 100%. So we've talked about a number of things here, kind of things that are impacting the market, where the market is, where it's likely to go. Sounds like we're both, I don't want to put words in your mouth, but on the same mind that probably likely to see, in real terms, flattish prices going forward with a potential for some type of correction, but not likely a crash. Is that about right?
That's my operating scenario right now is kind of the base case scenario, just slowly adjust over years.
And maybe we've talked about it on the show before, but you could probably explain it much better. For anyone listening at home that doesn't understand, when you're saying real home prices, maybe explain the difference between nominal and real home prices and sort of why it does or doesn't matter to someone looking at entering the market.
Yeah, the real home price, you're just adjusting for inflation. You're taking like the CPI and say, well, prices are the same, but we had inflation so this year, so that means the real prices are actually a little lower if you adjust for inflation. That's what I mean. So even if they're flat for 5 years, but with inflation, that means the real home price is going down a little bit after inflation.
And real home prices going down are not a problem to anyone because most people don't think in terms of real prices. An actual drop in the price of someone's home bothers them because if they paid $400 and they can only sell it for $380, they may have to bring in money to close. But if 5 years later it's worth $402, but based off of inflation it should be $418, no one thinks in terms of losing home value to inflation. They do think of losing it to an actual downturn. So what we're saying is things can correct going forward with a period of flat, low, no increases to prices because inflation is not going away. It may go back and moderate to the Fed's goal of 2%, but even at that, home prices are normalizing year after year. But with that sort of being my base case, your base case for what's likely to happen going forward, your son recently was interested in buying a home and you had some advice for him. So why don't you share that? Because this is what all of our people are thinking. The majority of people listening here are not homeowners and they're considering becoming a homeowner.
Okay, so this is my younger son. He's in Florida. He and his wife got good jobs. They're really established. They both got PhDs, and now they're in southeast Florida. And it was time to buy a house. They're in their early mid-30s, time to buy a house. And what I told them was, look, we're at the top. This was 2 years ago. I said, we're probably at the top of the market. So there is downside risk. Who knows what's going to happen? So what you want to look for is what I call a 10-year home, a home that if it doesn't go up in value in 10 years, you're fine. And it's a home that you probably can stay in for 10 years. So even if prices do fall, you don't have to change your job or whatever at the bottom of the market, which hurts so many people, the millennials in 2010 or whatever. So if it's a 10-year home where it looks like you're going to be able to stay in a long time, and you're fine if it's the same price in 10 years, good. That's what you want. So it means your life is in a place where you're going to be stable. You have good jobs, you're going to stay there, and you just want to settle in. And guess what? His wife is pregnant now because they're getting stable, they're getting set up, they have the house. And so things are working according to plan. And I assume over time, although let's say that works out, the house is the same price in 10 years, but I assume his income is going to be going up. He's early mid-30s, be going up for the next 10 years. So the actual price of the house is going to be going down to him because his income's going up, and the real price, the real monthly payment, so to speak, he's got a 30-year mortgage, will be going down every year due to inflation. We did great in inflation. Well, we did great in real mortgage payment prices. I did anyway, when we had that 1 year with skyrocketing inflation. That means your income was going up, but my 30-year, well, I guess it's 20-year mortgage at that time. It was 15. My 15-year mortgage wasn't going up. I switched from a 30 to a 15.
Well, without even being a mortgage person, you've talked about the benefit there of what owning and having a mortgage is. People love to do what about taxes? What about maintenance? What about upkeep? Well, amazingly, homeowners pay all of those things, but they fix the majority of their housing payment other than the taxes and the insurance. And they have the option to lower it. You take a 30-year fixed, you always have the option to refinance. You have the option to bring that down. Renters have the option of moving at a moment's notice, being very flexible, being able to chase a job, chase a girl or a guy, when the time is right in their life. So there are benefits to renting.
Great way to explain it.
The downside is you're exposed to inflation, and when we have limited supply in rentals, we are definitely seeing moderation in rent price appreciation, but it's going to be there. 10 years from now, rent prices are going to be higher than they are today.
Oh, yeah. Another big one is that people want to customize the house the way they want. It's not even a money thing. It's like, I want to paint it the color I want. I want to be able to add on. I want it to be mine and not somebody else's house that I'm renting. So there's a lot of value that people put into that, just having those options.
1,000%. John, we've really only scratched the surface of all of your content. Like I said, you have a 70, 80 email series that you'll send out to people with all sorts of thoughts. So if you're open to it, we would love to have you back in the future to go over that. But if anyone's watching and goes, hey, I would like some more information, what's the best way to follow you, get some more of your content?
I have a website called Real Estate Decoded. I have a Substack, which is basically the same thing, called John Wake's Real Estate Decoded. And I'm also on Twitter at just John Wake, where I'm pretty active there. Got 11,000 followers there.
And that's not just for people in the Phoenix market. A lot of Arizona content, but a lot of just nationwide real estate market content.
Yeah, it's geeky. It's a numbers stuff.
You say geeky, but I tell people, like, this is the biggest investment most people are ever going to make. It's the biggest liability you're ever going to take. You owe it to yourself to be a geek for a period of time, or to find geeks who can help you with that. That was a good transition on my part there. So if you are looking for help on the mortgage side, if you are looking to get connected with an awesome realtor that follows data, follows people like John, follows people like Mike Simonson at Altos Research, some of the other guests we've had, and can advise you, we have a link down in the description where you can reach out, get connected to us on the mortgage side, get connected to an expert realtor, because we talk about all the time, it is an 80-20 industry. 80% of the folks in real estate and mortgage are not good. You want to make sure you're getting in the top 20%, better yet, the top 5%. And we think we have a pretty good tool for getting you connected on that end. So, John, before I let you go, any final thoughts? Anything you think that our audience here of mainly first-time buyers, but people wanting to buy or invest in real estate are considering? Any pearls of wisdom? Just
talking about information, the one mistake I made when I bought my first house in the 80s, I wasn't prepared. I hadn't done the research. I should have read a book. They didn't have the internet back then. I should have read a book on how to do it. I would have avoided a lot of problems. So I'm thinking today it's like just following you and stuff like that is super valuable just to get up to speed on all your options. You don't have to agree, but at least you know what the decisions that have to be made, etc.
100%. John, I appreciate your time. For those of you listening, hope you found value here. I definitely found value from the conversation. We'll be back again next week. Until then, adios, amigos.
Thanks, Josh.